Hello, everyone. We're just going to give it a couple of minutes for people to get here, and then we'll get started. So please bear with us. Okay, well, we'll get everything started now in the interest of time. We just want to make sure that we allow enough time to get through all of the content. So, welcome to Financial Basics and Navigating an Uncertain Economic Climate. This webinar is being delivered in partnership with the GPs in Training faculty at the RACGP, along with the Commonwealth Bank. And we also have a special guest from William Buck here as well. So we're going to be covering a very broad range of topics today. Very excited. Hope you enjoy. I will hand over to Anthony now, who's going to get everything started.
Thank you for the introduction, Ari. Good evening, everyone, and welcome to the Financial Basics and Navigating an Uncertain Economic Climate. My name is Anthony Ciano. I'm from Commonwealth Bank's Premier Banking Division here in Perth, WA. I'll go through the introductions in a bit more detail in a moment, but we'll just progress very quickly through the slides. Give me a second. Before we do proceed this evening, our acknowledgement of country, I'd like to acknowledge the traditional owners of the lands from where each of us is joining the webinar today, and I wish to pay my respects to elders past, present, and emerging. For tonight's webinar, just bear in mind the control panel at the bottom. You'll see it in your left-hand corner. If you can't see it, you'll be able to navigate it to the right when you move the screen, and just hover to the right just to have access to all the navigation tools. You will be on listen-only mode, so you will be muted, but there will be an opportunity at the end of the seminar for you to pose any questions to myself, to my colleague Binny and Julie O'Reilly from William Buck, just in relation to any queries you may have. The presenters this evening, as I mentioned, my name is Anthony Ciano. I'm a Senior Relationship Manager at the Commonwealth Bank here in Perth, Western Australia. What I essentially do for my medical clinicians and our professionals in general is look after holistic banking, in particular residential and investment lending needs, and just helping to build and accumulate wealth in that landscape. On a side note, I do partner in my spare time with the Multiple Sclerosis Society of WA, MSWA, and support them with their yearly function in Perth, the Step Up for MSWA, which I've been a part of now for nearly a decade, just helping those that are impacted by neurological conditions. With that in mind, I'll hand over to Binny very quickly just to introduce herself, and then we'll get Julie to introduce herself too.
Hello, everyone. My name is Binny. I'm a Premier Relationship Manager in Melbourne. So same as what Anthony do, I look after lots of medical clients and help them with their financial well-being, as well as providing them with lending solutions. In my spare time, I like to mentor and support other women in my multicultural social media by providing them with financial advice, as well as providing some tips on being a mother.
Thanks, Binny. My name is Julie O'Reilly. I'm a director here in Brisbane at William Buck. I'm a business advisory director in the medical space, and I love working with my clients and advising them and educating them in relation to taxation, accounting, and really guiding them through their career path. So I will hand over to Anthony to kick off our presentation this evening.
Wonderful. Thank you, Julie. So with tonight's seminar, the learning outcomes are as follows, and you'll receive CPD points as follows: identifying strategies to help budget and deal with cost of living pressures, reviewing taxation and accounting basics as a contractor in a practice or a locum model, managing debt and improving savings to achieve financial well-being, and saving for your first home. The way we've designed this seminar is just broken up effectively into 6 key areas. So the first one is financial well-being and your money mindset. As the name suggests, managing your finances, providing that mental foundation around staying motivated and disciplined to succeed, navigating the rising cost of living, and providing a brief economic update, I guess in tandem with tonight's budget announcement. Thirdly, we'll look at budgeting tips 101, and Binny will take us through a few of those measures, in addition to saving for the future, which works in tandem as well with saving for your first home. And then finally round off with managing debt and looking at HECS and help debt as well. As always, just a brief disclosure, any information that we discuss tonight is obviously general in nature and does not take into account your specific circumstance. So I'll leave this for a few moments just for you to have a quick glance at it, just to have a quick, to ensure we're all on the same page with respect to that. All right, wonderful. So the first topic we will dive into is the financial well-being and your money mindset. Sounds a little bit cliche and a little bit dull, but in essence, what we discuss here, financial well-being, the textbook definition looks at it as your ability to meet your day-to-day expenses, how prepared you are for an unexpected event or an emergency, and taking the necessary steps to lead the financial future that you want. So that's the very broad sense, but the reality is when it comes to financial well-being, it means a different thing to each of us, depending essentially on our life stage. So we've got there the everyday transacting, you've got your rainy day, and then your goals and your aspirations in the final corner of the presentation document there. In the next point, we've just mentioned what is your mindset towards money. So let me just go back a moment. I think the slides have just changed. Oops. Excellent. Fantastic. So your mindset around money can obviously take the positive stance or the negative stance. The first one being taking an honest and objective viewpoint on it and just being realistic with what you can achieve at your current life stage. If you're an intern, medical clinician, obviously things will evolve as you progress through your career versus if you're towards the latter parts and you've established yourself quite well. The other points is to avoid comparison to others and not taking on the notion of keeping up with the Joneses, forgiving yourself for any financial mistakes. That includes making sure that you practice ways in which to rectify any things that may occur, and finally practicing any gratitude towards any little wins that you may have. The key theme is keeping a key focus on your financial objectives that tie in with your life stage as well. So just keeping a very close guy on that is very important. The negative side about money mindset is keeping an avoidance or ignoring. So again, just putting things to the backside and not really addressing any issues that may be pressing, but also making that comparison to others. This is quite fond in the current landscape due to the nature of social media and so forth, and that makes it very difficult to, I guess, make sure you're creating your own path and following that according to your own goals and objectives. And obviously treating money as the center of everything. So keeping a very open mind as to what's really important in your life and your life stage in particular. Okay. Fantastic. So the next part that we'll be touching on is navigating the rising cost of living. And this will obviously work in line with tonight's budget, which is occurring by the Treasurer, Jim Chalmers. So what this means is finding that since 2010, above nominal terms, doesn't seem like it's very high. But what we've uncovered is obviously the cost of living crunch is taking its toll on many households. And that's obviously due to a number of factors, including inflation and the supply shortages that are occurring globally as well. The next point that we speak about with relation to cost of living is the interest rate environment. So why interest rates and inflation are linked, and that's the reason for how the economy functions. So with the cost of living pressures and interest rates being as they are in the current climate, the central bank is in a position where they're trying to quell this inflation scenario. So as you perhaps heard in the media, inflation is quite high at the moment at 7%. And the Reserve Bank is tasked with reducing that to a band of 2 to 3%. So on one hand, the inflation or the economy is running quite hot, which is due to a number of factors, which include things like the elevated commodity prices, the migration that's occurring throughout the economy, the supply shortage in housing. So on one hand, that's going quite strong. But equally, the only way that they can try and reduce that is using monetary policy or interest rates to ensure that that's taken into effect. So there is a bit of a dual scenario that the Reserve Bank and government are working on to ensure that they're keeping the economy on an even keel, which is what the Governor Lowe alludes to regularly in his media updates. So this kind of translates to what happens to housing prices. So housing prices are strongly linked to both interest rates and inflation. So with interest rates moving upwards and the cost of debt, in a sense, increasing, that obviously means that house prices are inversely impacted. So typically with the interest rates moving north, it's obviously meaning that house prices are taking its toll, because lending is a function of credit, and if credit is being made difficult to access, then of course housing prices are going to feel the brunt of it. Already in the broader sense, the national housing market, Sydney and the Melbourne markets in particular, although in the last couple of months we've seen a bit of a resurgence, but of late we've seen that the prices have begun to kind of plateau. Other parts of the markets have also seen some consistent growth, but whenever we look at house prices, we need to bear in mind that it's not simply one market. There are multiple markets within markets that need to be kept in mind. And as the slide acknowledges, Australian house prices are some of the highest in the world. So in this slide, we just basically touch on the top 5 tips for dealing with cost of living pressures. And the first one, which we've briefly touched on, is know your numbers. So making sure that you have a concise budget or some form of outline. So that could be something in the form of a Microsoft Excel or some form of spreadsheet that just gives you a sense of what your income is, what your expenditures are, what's your assets, what are your liabilities, and just working and reverse engineering what's going to be the most sensible way of spending for you. And that follows on to the next slide, which is tracking your spending. There are a myriad of options, including within the CommBank app, which you can use to monitor your spending, but also external apps that will allow you to track where your spending is being directed for any spending that might be able to be reduced depending on your situation. The third point, shopping around for better deals. That's where you speak to your premier banker like myself or Binny, or your accountant as well, like Julie, in this sense, where you can obviously look at revising and making sure you've got the appropriate structures in place to minimize or to make sure your situation is structured as best as possible. Removing temptations as well. That may include things like subscribing from or unsubscribing from things that might lead you astray with some of your spending, but also just being very honest with yourself around key things that are most important to you. And does that spending lead to furthering that goal, or does it actually reduce you from accessing that goal? So keep that in mind. And the final point is talking to someone who can help. So that's whether it's the banker, like Binny and I, whether it's a financial counsellor, whether it's your accountant, just seek out that support, because there's always a team of professionals there to support with anything that does arise. So I will pass it over to Julie now, just to explore some of the tax and accounting basics to bear in mind.
Thank you so much, Anthony. So we are going to run through tonight some of the accounting and tax basics. that you'll see is a change being a new fellow compared to being perhaps a registrar and an employee. So the first thing to come to mind, if my slide will move on. One moment, here we go, I've done it. Beautiful. So things to think about becoming a sole trader. So things are a little bit different being a sole trader rather than being an employee. So how to start, essentially what you will need is an ABN, Australian business number. Then you should reach out obviously to Anthony and to Binny, our premier CBA bankers, to establish a business bank account for you. The reason for that being, what we want to do is any income that you're earning as a sole trader should go into that CBA business account. And then you should pay for any expenses pertaining to your sole trader income. Any tax deductible expenses should come out of that business bank account. And then you can feel free to sweep any of the balance of those funds out of your business bank account into your everyday spending account or your savings account. Some questions I commonly get asked are, am I at high risk of being sued? Potentially. So as an employee, you're looked after under your employment contract with the practice. However, as a sole trader, what you will need to do is take out your own professional indemnity insurance. So your professional indemnity insurance should then come into place should you be at any risk of a patient being sued or malpractice for those sort of things. Commonly, we are asked, can I employ family members? And typical accountant answer, it depends. So when we start working as a sole trader, what will happen is you'll commonly be given a contract for work, and depending how that contract is worded, depends whether we can employ family members or not. So there are generally two different methods of a contract where you'll be a sole trader. And so one method does allow us to employ a spouse or a family member who may be able to assist you with administration or bookkeeping tasks, where you're able to remunerate them by way of a wage as well as superannuation. So the long and the short of it is, it does depend, but there are certainly instances where you can employ a family member. Other questions I commonly get asked is, can I claim my car as a tax deduction? So that is a great question. Claiming a vehicle as a tax deduction, generally there are two methods to claim the vehicle. You can either use the cents per kilometre method for motor vehicle claim, which allows you a maximum deduction of about $3,800, or you could choose to keep a logbook for up to for a period of 12 weeks. And then that logbook will then show what your business use percentage is likely to be. So things like traveling from home to work and home again is not deductible. That's seen as private in nature, sort of like me going to work and going home again. However, if you are working between many workplaces, or at least two workplaces, then that does open you up to have travel that is tax deductible. So if you are in that situation where you're contracting to different places, different practices, then do reach out and we can talk about how that may be tax deductible and what that looks like in terms of purchasing a vehicle or claiming your current vehicle as a tax deduction. So another common question is, can I pay super for myself? So yes, you can pay super for yourself. Do you have to? No. So you have the option to put nothing into super, or you have the option to maximise your super up to $27,500 each year. If you do choose to remunerate yourself by paying superannuation, you will receive a tax deduction for, or you can receive a tax deduction for that up to the concessional cap each year. So certainly things to think about as you're entering into being a sole trader, which is quite different from being an employee. Common question is, am I going to pay a lot of tax? I don't like tax. Nobody likes tax, but it's one of those things that we have to obviously do being Australians. So we are going to pay tax. What we're going to do when you receive your income into your business bank account and you pay out all of those expenses that relate to your work, before we send our money out into our everyday savings account or everyday spending account or savings account, we do need to put aside money for tax. So a rule of thumb would be about 30% put that aside for tax and about 10% put that aside for superannuation. Usually that's a good rule of thumb to make sure that we're certainly saving for tax and super, so you don't get caught out. The other thing to do is, when you've started working as a sole trader, trading under an ABN, there's money coming in, there's money going out, we're saving for tax, we're saving for super. It's a really good idea at this time of year, say April, May, June, before 30 June, to reach out to your accountant and say, hey, this is how much I've earned for the year. What tax planning opportunities are there before 30 June? What advantages could I take? And make sure that you've set aside sufficient amounts for tax and for super. So it always pays to have a tax planning meeting, say April, May each year, to make sure that we've set aside sufficient cash for tax and to make sure that we've made super deductions, if that makes sense, in that financial year to do so, and there are no tax surprises, I suppose. So in order to have an ABN, obviously there's going to be some costs involved, whether you register for GST or you don't register for GST. These are all sorts of things that can be discussed with your accountant. But if we are registering for GST, we do need to lodge business activity statements. So I've got the costings there as to what that might look like per quarter for you. And then you'd need to lodge a year-end tax return. That year-end tax return would have a business schedule in it for your sole trader income, as well as any other income, investment income, salary and wages, those sort of things that you would have in there. So you may or may not have heard of the personal services income tax legislation. PSI basically, or the PSI, personal services income tax legislation, basically says if you go to work to earn the money, then you must pay the tax. So you might hear of colleagues saying, well, I take all of my money and I take just half of it in my name and I split the rest with my spouse and we just pay tax on it in that manner. Unfortunately, the personal services income tax legislation comes into play and says, no, you can't legally split your income with your spouse, with your family members. Further, you can't use an entity, so a company or a trust, to trade as a doctor and split your income that way either. Essentially, what the personal services tax income tax legislation looks at, they look at what was the income that you earned and attributes that money out to you in your individual return. So they look through any company or any trust structures that you may have put in place and make sure that any of the income that you have earned that you are taxed on personally. So if you've heard those sort of things, those sort of things are common to hear, but unfortunately you legally cannot split money with other family members and you can't use a structure to hide behind to try and manipulate that either. So I thought I would run through the different types of structurings that we have. So usually there are at least two businesses in play when we have the individual doctor contracting to the practice and then the practice looking after the administrative support, providing the rooms, meeting and greeting the patients and doing the billings on your behalf. So each of these doctors, who you can see along the top of the slide there, would each be running their own sole trader GP business, possibly running through their own individual sole trader ABN. And then that practice would potentially be in a different structure. That structure might be a company or it might be a trust or a unit trust, depending on the ownership of that. But essentially what we're looking at is two very separate businesses. One, the individual doctor seeing the patient, and two, the practice providing that support and administrative services. So I thought I would just touch on some different work arrangements. So when you do work as a contractor, what you do need to have is an ABN, as I suggested before. So I've listed that website there for you, abr.gov.au, where you're able to obtain an ABN on your own. Alternatively, reach out to William Buck, myself, or one of our William Buck team members, and we can assist you in obtaining that at no charge to you. The other thing that you may or may not need to do, depending on your contract, is register for GST. So that does come down to the contract that you've got with the practice or practices that you're working for. So it's important to send that contract through to your accountant to be able to have a look as to whether you should voluntarily register for GST or whether you should wait till you reach the GST turnover threshold of $75,000. If you do register for GST, or when you register for GST, you will be required to lodge your business activity statements, and that is generally quarterly. And then the third thing that you'll need is a bank account. As suggested before, it's really important to keep any business income separate from your everyday spending account, and that's where you reach out to Binny and Anthony, your CBA Premier bankers to arrange that business account for you, just to keep everything nice and neat and away from the rest of your spending. So I have touched on many times throughout the presentation this evening, there are different contracting models available to you. So the first one is where we work under the locum model. This is a contract for personal services. So technically, under this particular model, you engage with the medical practice as opposed to the patients. It's a very similar outcome as to being an employee for both the practice and the individual doctor. However, there's another method, and this all comes down to the contract and the wording, the legal contract, I should say, and the wording in there, that you may work in the doctor in practice model. So this is a service fee type arrangement where you engage with the patients direct and you pay a service fee to the practice to do the administrative and support services for you. So potentially under the doctor in practice model, we have some additional tax deductions available. That's where you may be able to pay a spouse or a family member some wages and some super for being able to support you with some administrative, bookkeeping, those type of services at a market rate. This next slide here shows the difference between those two models. So the doctor in practice model and the locum model. Essentially, the guts of this slide is to show you that no matter which way that you contract with the practice, that you do end up with the same amount of money in your pocket at the end of the day. So it's patient fees less service fees gives the amount that come into your bank account. Otherwise, on the locum model, you might get paid a locum fee, and that does end up the same. The difference is just on that left-hand side where we have that doctor in practice model, that's the model where we could employ the spouse or the family member. So in that instance, you may end up better off from a tax perspective. So again, important to reach out to your accountant to review that contract, so just explain to you what what the contract says, whether we should register for GST, and whether we're eligible for those additional types of deductions. So a couple of tips and tricks that we will talk about. So probably my most commonly asked questions: can I buy a cool car? Yes, you can buy a cool car, but there are caveats on that. So in terms of buying a car, I always say there's no point in spending money just to obtain a tax deduction. You need to actually go and buy a car because you need a car rather than just chasing a tax deduction. There are two methods to claiming tax deductions on a vehicle. So the first one is that cents per kilometre method I mentioned before, about 3,800 in deductions on that one. Or if you're going to keep a logbook for me, you're travelling between different locations, that may end up more tax advantageous for you. In terms of purchasing the car, we need to be aware that there is a luxury car limit of $57,000, $58,000. That means that's the maximum that we can claim the depreciation on. And then we also need to look at how are you going to fund that car, whether that's going to be cash, whether you're going to go see Benny or Anthony and talk about a loan. And I know the guys from CBA will talk about that in the coming slides. We will circle back on what that looks like. In order to maximise your tax deductions, it's really important to retain your records. Without a record, it's really difficult to claim a tax deduction. So if you're not sure, keep the record. Write on it, write a little story for your accountant. This is what it was for, this is why it relates to my work, and then make sure you've just kept everything nice and safe. Nice and safe, where do I organise my records? Commonly, I find it easier for clients keep it in a Google Drive or somewhere electronic that they're able to share with me and my team at William Buck to be able to make that seamless way to claim their tax deductions. We talked before about not requiring a structure in terms of contracting, but some medical practices do insist that you contract through a company. So what do you do now, I suppose? So if the medical practice that you're looking to contract through requires you to establish a company, that's no problem. We can establish a company. It takes a couple of days to get the company organised for you. Essentially, it will be a little bit more work on your end, maintaining company records, making sure we're maintaining a separate company bank account, which again, the guys from CBA can organise for you. But that one will need a little bit more talking through at that point. So there's no panic about that, but it is something to be aware of, that if your practice does require you to organise a company, it is a good time to come and have a meeting and work that through with us. The last thing that I commonly get asked for is about traveling for work. When you do travel for work, again, I come back to maintaining your records, keep receipts for everything. So if you're traveling for a conference, for example, the cost of that conference would be tax deductible. The travel there and back, again, tax deductible. Food and beverages while you're on nights away, that sort of thing, should also be okay. It is important to note that if you're traveling for 6 or more consecutive nights, that you are required to keep a travel diary. Not War and Peace, but do make sure you've retained appropriate documentation in relation to that, so we can make that deduction for you. So I will hand over to Binny now to run through Budgeting 101 for us. Thank you.
Thank you, Julie. Anthony previously touched base of the rising cost of living we're all facing at the moment. So now I'm going to talk about how to budget. Yeah, thank you. So budget basically is a tool for decision making that helps you plan and monitor where your money is coming and going, so that you can control your spending, improve your financial situation, and ultimately save money so that you can achieve your goal and dream. One sec, I'm just trying to. Thank you. So now we just need to break into 5 different steps of, we're going to touch base on these 5 steps to talk about how do we budget. So before we start, the first is understanding about your income and expenses as well. So your income minus expense equal to how much you have left over, which you can save or invest. So the first one is start with your income. Know where your income is coming from is very important. What type of your employment you're in, whether you're full-time, part-time, or casual, and figure out after tax, how much income is your available source. Look at some way to improve your income as well. For example, investment, property, rental income. The second thing is work out your expense. Go through all your expenses by looking at your bank statement and assign them into each category. For each expense, you need to understand whether it's need or want. During this exercise, it can focus your attention on what you can change and what you can't. Then set up a target amount for each category as well. This is a good time to look for some unnecessary expense and scale back or cancel for them. For example, if you're expecting your electricity bill to be $1,200, it's a good idea to set up aside $400 a month or $200 a fortnight. Third one is, once you have a good idea of how much money you can allocate to different expense, you need to track your progress. This could be a spreadsheet, or if you are all traditional people like myself, I put everything in a piece of paper. But the principle is recording your spend through the months and against each category, which we're going to talk about in a second. Next one is automate your saving. After you look at your income and expense, it would be ideal for some leftover money to allocate for saving or investing in your future. Many financial experts suggest that we have 10% of your income available to be dedicated for future needs and future goals. This could be towards an emergency, rainy day funds, or any unexpected large expense which may come up in the future. Or you can save a bigger goal, for example, purchasing your property or save up for a holiday. Last but not least is getting to a habit of reflecting on your budget each month and see where you can make saving or an area that needs your attention. The next one is track your biggest expense first. So a good place to start is by reviewing your expense and focus on the big expense category. For majority people, housing is a big expense, whether you're paying a mortgage or you're renting. Where we live is one of the biggest expense we incur, and with the most of people has been feeling at the moment after RBA is passing on the interest rate each month. And if you have a mortgage, it's very important to know how much you're paying and adjust your household budget accordingly. If you haven't reviewed your home loan rate for the past 3 to 6 months, I would suggest you had a chat with your banker, for example, myself or Anthony, and getting to review your home loan rate. If you're renting at the moment, it can be very expensive. Right now, Australia, we are experiencing the highest migration from everywhere in the country. Therefore, we're starting to see the rental crisis. As a general guide, you should spend no more than 30% of your income on rent. While the rent is a bit hard to control, but if you're spending more than 30% of your income, it might be a good time to consider whether you can make change. For example, moving to a smaller place or find a housemate to share some costs. The next one is transport and the car costs. We all notice of increase of petrol over the last 12 months. So therefore, it's very important for you also to review your expenses, get the best price possible as well. In Melbourne, I know there's a few of the free apps available, which you can lock in the petrol price. You'll be surprised of how much money you can save. The next one is utilities, as well as look at different utility provider at least once every year to see if there's any better deal around. Also compare your energy plans as well. Food and groceries. Food is probably the second biggest area of household spending after housing. I've definitely feel like I've noticed the food cost has increased. Previously, $100 when you purchase in supermarket, you'd be able to buy whole trolley of food. Now it's probably like $100 you're looking at buying a basket. And so therefore it's very important to review your budget on the food as well. For example, buying bulk and avoid buying individual package portion, and then look for some cheaper alternative as well. And finally, review your insurance. So with the insurance, I normally suggest my client to review once every year. It is very important. First of all, you need to make sure you are covered correctly with your financial situation. Everyone's situation change. Having a correct insurance policy can be very important, especially when it comes to when you're making a claim. And secondly, you wanting to review your insurance to check if there's other cheaper provider as well. CBA, we do have different shopping offer on your app, which can help you save some money as well. So we talk about the foundation of successfully money management, but even the foundation can be overwhelming if you have challenge circumstance as well. So there's a couple of things that we need to pay attention to, which is better for us to manage our funds. There's a lot of factors that contribute why we spend more we intend to. Firstly, the classic thing is keeping up with your neighbor. Anthony previously had a discussion before. We can't compare ourselves to other people. Everyone's situation is different. Don't get tempted if your neighbor has purchasing to a new property or they purchase a new luxury car. Everyone is different, so don't get impacted by other people. The secondly is ease of payment. Ease of payment is one thing that we all talk about. Right now, everyone is got phone app, pay ID, and a credit card, so we don't really get to see our money, and we don't feel like we're spending money as well. And storing it all in your head can be exhausting. While you are not just planning on mortgage, we're also affecting other expenses, electricity, bills, groceries, everything in our head, which it can quickly lead to mistake as well. Managing money can sometimes feel like it's a juggling act. That's why there's a lot of digital tools are very helpful to manage on spending on an ongoing basis. You can automate direct debit a lot of this recurring bill and a payment, or schedule a payment in advance so that you have less ball to juggle your day-to-day life. Lastly, impulse buying. When you want something, everyone will want it very now. Temptation has a very strong influence on how important something suddenly seems in current moment. That's why supermarket always position all this chocolate at the checkout, where it's likely you have to wait and it's easy to grab some. So it's now we understand why we spend too much and why do we still do it, and how can we overcome this, which we can chat about in the next slide. So there are some ways to improve our spending. First of all, using bucketing technique and have different account for different spending, which we'll talk about later. But for myself, with my account when get salary paid to, I do have different accounts. For example, for a mortgage payment or for groceries, it's very easy to allocate your income and towards different account. Secondly is think carefully before buy now and then later. Use 2 and 30-day rules to control impulse buying. A lot of time we think we need something, but do we really need it? So wait 2 days for purchase under $100 and a 30-day for purchase over $100, and see if you still need it. That's really true. Sometimes we just really want it, but maybe if we take more time to think about it, then it gives us more time to think about whether do we need to spend that much. Next one, it could be reduce your credit card limits as well. Credit card can be dangerous if we don't use wisely. Therefore, having a good credit limit, which you can easily to control your spending on. The next one is schedule a treats or rewards. This can help people save as well. Just make sure you don't undo your good work. And then lastly is use internet to check if you're getting the best deal, particularly for the large purchase and utilities. One of my colleagues always tell me whenever you're purchasing a washing machine or like big furniture, look around different store and check whether they have different deals available, or even using like cash rewards. Sometimes they have like deal for different website, therefore you can generate some saving here and there as well. Okay, so as I mentioned earlier, this is a simple approach to budgeting, which is allocating your income to different categories. Here is just some example which you can have a look. Majority people spending on essential spending, rainy day, 1 day, and the tax. For example, if your total income is $2,000, you can allocate 40% on rent and utilities, groceries, household transport. This is probably the biggest expense that we are spending at the moment. The next one is 15% on eating out, shopping, and entertainment, 10% on rainy days, which is cover for major car repairs, medical and illness, big and unexpected costs, 10% for 1 day, which is your goal to purchasing a property, car, or holiday, 25%, which is tax. And Julie, do you want to touch base on these things just in terms of saving money for your tax? Because this is very important, especially for lots of self-employee.
Yeah, thank you, Binny. Certainly that's where we find sometimes people who are new to being a sole trader do come undone. So it is making sure that we do form those important budgeting habits from the start, as in from the very first pay slip. That's really important. The first pay packet, I should say, is very important to make sure that you are setting aside that money for tax and that money for super, and just get into that regular savings habit. The CBA Premier Bankers who are online tonight are able to assist in setting up particular bank accounts that are separate to that business account, separate to your everyday spending account, so you can make sure that you're setting them aside appropriately and not getting caught out at year end. Thanks, Binny.
Thank you so much. Thank you. Yeah, so once you have a good idea of how much money to allocate for different expense, you need to track your progress. So there's a couple ways we can help with this. First thing is budget planner, which is available on Money Smart budget planner website, as well as Commonwealth Bank. We do have Money Plan as well. Money Plan including category budgets, bill sense, as well as cash flow views, which gives you a complete picture of your income, spending, and going. Now I'm going to pass to Anthony, which will chat base about saving for future goal.
Brilliant. Thank you for the warm handover, Binny. So in essence, now we're looking at part 4 when it comes to managing your finances and taking control. So this obviously looks at the bigger purchases, acquisitions, which can be overwhelming, but obviously it's saving towards that goal, whether it's a motor vehicle, whether it's your first home, whether it's an investment property. It's around just getting a better sense of some steps to be mindful of. So as we progress, I'm just going to see if this will give me control. Here we go. Excellent. So when we speak about preparing for a rainy day, the general rhetoric around this is normally having 3 months of your salary, or at a minimum of $2,000 being saved up for that rainy day. Again, a rainy day can be a very different scenario for each of us, but the general rule of thumb is that 3 months to 6 months of salary, if you can, just being there for those uncertain or unexpected events. But also making sure that you make regular transfers to this. So we can set up multiple buckets, if you will, or silos, where you can transfer your monies into that rainy day account, into your everyday spending account, into your one-day account. It's a good way of just understanding and getting a better sense of where your monies are being placed. Okay, fantastic. Once more, your savings are obviously in great shape when you have at least one medium to long-term goal that you're working towards, and you understand your goals and have them prioritized. Because as the notion goes, if you don't have anything concrete, then you're kind of shooting at a dartboard without anything that's really certain. So you can kind of come unstuck if things don't go according to plan. So just making sure that you've got a clear and concise set of goals that can allow you to realize them in a timely manner. So we've already touched on this, but we'll go over it. Binny has mentioned automating your savings, so separating them into different accounts, whether that's your transaction account or offset accounts. I find it's a very useful tactic just so that you can manage those everyday expenses for maybe your utilities. Then you might have a day-to-day transaction account for your salary. You may have another account for your holiday spending, for example. That's not the only way, of course, but it just does help for you to just siphon things out and get a better grip of where your monies are going. The other point is looking for bonus interest and incentive saving accounts. Obviously now, compared to 24 months ago, there's some really attractive interest rates and accounts that we can definitely support with. So that would also just help to ensure that your money's working best for you. As Benny mentioned, there are many apps, including the CommBank app, that you can track your progress around where your monies are going and just giving you a better sense of how the budget is looking. And also the second last point where it says looking at other savings and investment options, whether that's sitting down with your accountant and fleshing out that plan, and then working alongside your banker to make sure that we can action those plans accordingly and to ensure that we've got the right structure and systems in place for you. And finally, the offset account for a home loan is effectively a vehicle that reduces the interest that is charged. So for example, if the loan is $500,000 and in your linked transaction / offset account, you hold 100,000 in there, instead of the loan being charged interest on 500,000, it's charged on the difference, which would be 500 take 100, which would be 400,000. So it's a very useful tactic where you're saving interest, you're not being taxed on it, and you're obviously still hammering down the interest on your loan without doing too much. So when we spoke about purchasing or acquiring these items, one of which is a car, which is perhaps second to buying a home in terms of the expenditure. And so we'll look at a few things that pertain, or a checklist, when it comes to buying a vehicle. So as known, we've already touched on it, Julie mentioned, if you're looking at splurging on a vehicle, there's obviously one option, but of course, there are a few other things to be mindful of when buying a vehicle, and we'll touch on them now. So the first one is whether we go down the path of new or used. We would have found in the last 12 to 24 months that there's been a significant shortage in the used car market, normally a function of the shortage in semiconductors globally, but we're beginning to see a bit of an equilibrium now with demand and supply. So those costs are starting come to some sense, both new and used. But obviously, when you weigh up buying a new car versus a used car, you just need to be mindful of, I guess, the trade-off there. So, for example, if you're buying a used vehicle, you just need to ensure that you've done the appropriate checks and balances to ensure that the vehicle is obviously in good working condition. So, having an independent mechanic or someone reliable to inspect the vehicle. You can also do what's called a PPSR register or search, or personal property security register, which Julie can probably talk to more, but that also just gives you an understanding of whether that vehicle has any mortgages or any chattels against it. So any loans that might be against it, given that it is a used vehicle. I guess on the flip side, with a new car, you're paying for the luxury of having something that hasn't been tainted or touched, but obviously that comes at a premium typically. And of course, that leads on to the on-road costs component as well. So whenever you're looking at purchasing a vehicle, just be mindful of the stamp duty and compulsory third-party insurances involved. That will obviously be applicable to any vehicle that you acquire. The next point which we talk about is either using your savings towards purchasing a vehicle, or whether we go down the finance route. Again, I might now just pivot quickly to Julie, who can give us a bit of an insight around, I guess, the benefits and the trade-offs around the different types of finance from a tax perspective, which I think will be of most use for this evening.
Fantastic. Thanks, Anthony. So as Anthony mentioned, there are a couple of different ways that you could finance the vehicle. So I'll talk from an accounting and tax perspective. If you do use your savings, there are no deductions, I suppose, for any interest or interest lost or those sort of things, but you would still get all of the rest of the deductions. If we've kept that logbook, you'd still get to claim the depreciation on the vehicle, the on-road costs, fuel, repairs and maintenance, insurance, all those types of things. However, if you were looking at different finance options, you may wish to consider using something that's called a chattel mortgage or a goods mortgage. What that does allow is you to claim the GST portion upfront in your business activity statement, and then it does allow, depending on tonight's budget, if you bought it before 30 June, you may be allowed to claim that as a deduction in full as an instant asset write-off. If not, it would revert to the tax commissioner's depreciation rates, which depreciate a vehicle over an 8-year period. So we would look at depreciation over a period of time. If you chose a finance option such as a lease itself would be claimed over each period that you make a payment. So it is important to have a chat with your accountant and your banker as to what finance options are available to you and which finance option might suit you best, because while colloquially we might all call them a lease, there are very different financial and tax outcomes depending on the type of loan that you take out for the vehicle. So always important to reach out before you sign any documentation so we can have a look at that for you. Thanks, Anthony.
Wonderful. Thanks for the summary, Julie. Very good overview. The other point before we touch on to saving for your first home would be just the insurance, of course. You can look at compulsory comprehensive third party or just simply third party, and that would obviously, if you do the comprehensive insurance, it typically would cover both yourself as a vehicle owner, as also the third party or anyone that you have any issues with on the road. So there are different options along that path as well that need to be considered, not just the compulsory third party that the government requires you to take out. So this then leads us to the next part of our presentation, which I'll quickly pivot over to in a moment. Wonderful. And I'll hand it over to Binny now to give us a bit of a summary around saving for your first home.
Thank you so much, Anthony. So if purchasing your home is your goal, so we do have some tips to help you on your home buying journey as well. Okay, so when it comes to purchasing a property, there are 5 steps which you need to consider to work out how much you'll be able to borrow. Completing these steps will give you an idea of the price range, help you start your property on the right foot as well. The first thing is calculating your living expenses. So when it comes to home loan appointment, the first thing you're going to sit down with your lender is work out how much your current living expenses are, which gives you a good start in working out how much you'll be able to afford. Normally, the bank will have different categories in terms of food and groceries, utilities, bills. Be as thorough and realistic as possible with your expenses, and think about the things that may change as well. Especially, we all notice that with the interest rate uprising, you may have to think about more like for public transport and have extra costs to cover, such as strata and a council rate as well when it comes to purchasing an apartment. Secondly, is understanding your borrowing power. Understanding your living expenses is important, as well as understand how much you will be able to afford. You're going to sit down with your lender. They will have a chat with your current income. What's your current bonus-based income, as well as your current commitment? For example, credit card, personal loan, car lease as well. And then we're going to work out together how much you'll be able to borrow. Next one is work about the buying cost as well. Purchasing a property is not just about the price. You're also looking at other costs associated with that as well. For example, stamp duty cost, which is the tax we'll have to pay, whether you'll be eligible for any of the first home guarantee scheme or stamp duty concession. It's good to have a chat with your solicitor and conveyancer as well. You can also using the stamp duty calculator online to work out the cost. Next one is decide how much you'll be comfortable of paying. I usually will sit down with my clients and ask them how much you'll be able to afford based on your current income. For example, if your rent commitment is $2,000, are you comfortable of paying $2,000 for your mortgage? Last but not least is saving for deposit. Ideally, you want to save as much as possible for your deposit. This means you don't need to borrow as much as you need, and you're going to save your interest. And so if we're going to move to the next slide, I'm going to have a chat about what deposit I will need. So generally, the bank will able to borrow up to 80% against the property value. However, being a GP, which means you'd be eligible for lender mortgage insurance waiver. So for those who doesn't understand about lender mortgage insurance, it's insurance that you're paying to protect the bank, which in the event that you'll be default on your payment, it's a once-off insurance and it is non-refundable. So right now, all the bank has been have professional offer to help you purchase your property quicker and saving money on lender mortgage insurance. It's a very good to have a chat about banker to see what are the package available, which you can save a lot of money towards lender mortgage insurance. For example, here, these are example only, and many banks allow doctor to borrow up to 95% without lender mortgage insurance. However, there are criteria applied and it would be subject to credit approval. And next one, we're going to talk about there are a few of the local experts who can support you in terms of your home purchasing journey. First one is, for example, myself and Anthony will be work through your personal information and also understand how much you're currently spending and also your current commitment and work out your pre-approval for you. The next one is solicitor and a conveyancer. They will work through with you about all the legal documents you sign up for, and as well as any government guarantee scheme which you'll be eligible for. They will also help you as well. The next one is real estate agent. A touch base with the agent is quite important as well, especially with the area that you're wanting to purchase, because they might have some of the market sell as well. Next one is accountant, for example, Julie as well, who can also support you with your property purchasing journey. Julie, can you touch base on what are the steps that you are helping your client with the property purchase, especially in terms of if they're a GP, they want you to consider purchasing investment property, whether to purchase under a personal name or trust?
Yes, thank you. Thank you, Binny. Yeah, it is important to reach out to your accountant as well as everyone else that Binny had mentioned during this process. It's important to reach out in advance. So for example, if we're looking to purchase an investment property, it may not be most advantageous to put it in your personal name being a GP. You may need to establish an entity. And again, that entity can take a day or two or 3 to establish for you. So those entities would need to be established before you go and sign a contract to make sure they're in the correct legal name. Ideally, it would be great to reach out to Binny or Anthony or your CBA Premier banker to make sure that you do have like some pre-approval in place. So you've got some comfort around what we're going in to buy, and then making sure any structuring discussions are had, whether you're putting in your name, your spouse's name, a structure, those sort of things. I know we do have another seminar coming up in relation to property, which we'll expand on this. But if you take away anything from today, I suppose it's making sure you're working with the team that's listed on the screen there, reaching out in advance. Don't sign anything until you've had a chat, because it's easier to get it right up front rather than try and fix it. The fixing can be a little bit costly.
Yes,
Thanks.
I agree.
Thanks,
Yes.
Binny.
Yes, thank you so much, Julie. I want to emphasize on purchasing the structure. It's very important to get it right in the first place. Have a chat with your accountant to see what's the best structure for you. Because I do have a clients where we've done the pre-approval purchasing under their name, and 1 week after they want to change the structure under the company trust, which can be very stressful time for everyone as well. Therefore, it's very important to make sure you structure right before you sign the contract. And the next, I'm going to pass over to Anthony, which will touch base on managing debt and student loans.
Thanks once again, Binny. Just wanted to reiterate your point around building that team of professionals. Not only do we not want the wrong structure being engaged with, but obviously making sure that the team of professionals around us are obviously working in our favour. So you don't want to be left with, you know, a banker who may not be as familiar with a particular market, or simply just understanding this type of loan that might be suitable for you. So I think building that network is fundamental. So great point there. This part of the presentation is rounding off, and it's the final component where we're looking at managing debt and student loans. So in particular, we'll look at the HECS kind of paradigm. So I'm just going to see if this will allow me to, a moment. Here we go. So in this slide, we talk about the HECS or HELP debt, which is a compulsory repayment against any student or training support loan. In particular, if you're going through medical school, that can be quite a significant amount of debt. And the rhetoric that's normally put forward is that it's a debt that you don't have to worry about. Unfortunately, it is indexed to the CPI or inflation. In the past, of course, that hasn't been much of an issue because it's been less than 1%. So the mantra was it's the cheapest debt that you can potentially have. But in the latest ATO update, they've indexed it to 7%. So in anyone's eyes, it's not a very cheap debt nonetheless. So either way, it will be part of your taxable income whenever you need to repay that back to the ATO. You can make voluntary repayments, but there will be a compulsory component to that. And the ATO website does provide a myriad of different tools that you can engage with. We will just progress now to a very simple example where we have Christina here, who has a taxable income of $50,420. I probably will pivot this to Julie just because of the tax nature of it, and she'll be able to just kind of share how the mechanics of it are. So Julie, do you mind just giving us a bit of oversight in this respect?
Of course, thank you, Anthony. So what's important to talk about on Anthony's slide here is your taxable income is one component of it. However, your HELP repayment rate, which is a sliding scale, so below $48,000, we're not repaying any HELP debt to the ATO, but that slides, you know, from 1% up from there. So it's important to note that it's not based on your taxable income; it's based on your adjusted taxable income. So, for example, in the slide here, we've got net investment loss, we've got reportable fringe benefits, we've got super contributions, those sort of things that we've made. All of those items get added onto your taxable income to work out which repayment income payment rate applies to you. So I did speak earlier that in the April or May leading into June, it's an important time to meet up with your accountant and have that tax planning. This would form part of that. So we would look at what is your income level, what tax advantages could you take care of before 30 June, and then work out how much will your tax bill likely be for the following year. in that calculation, it's not just what is the tax that you need to pay on your taxable income, it's also including what is your HELP repayment requirement. So that way there are no tax surprises. I've not yet met a client who enjoys a tax surprise. So it is important to have those conversations early, so you're not surprised and you do have time to plan for that. But that does come back to forming those budgeting habits, those savings habits that have been interwoven throughout our slides this evening, making sure we are putting the correct amount of money aside, and having those conversations and those meetings early, so you're not surprised when you receive a tax bill upon lodgement of your tax return. So just important to note, there is a difference between the taxable income on your tax return and what the HELP repayment is calculated on. Thanks, Anthony.
Brilliant. Thanks again, Julie, for your guidance there. We'll now just pivot, my screen will permit, to the notion of debt being difficult to manage. So quite interestingly, at Commonwealth Bank, we have a dedicated behavioural finance division or behavioural economics team here that obviously ask themselves that same question around the difficulty of money management and having the most appropriate money mindset. So one of the key things that they talk about is understanding interest rates. And that's the idea of understanding what that actually entails, because you get hit with an interest rate. Do you know the longevity of the actual loan itself? Are there any other hidden costs that you need to be mindful of? Really getting a good sense of where interest rates are, how they can be molded or changed, especially if you have a variable rate, which can obviously change in line with business conditions versus a fixed rate, and what the merits of each of them are. So it's very important to have a good sense of what they mean for your situation and how that may be impacted in the future. The second part is looking at the perception of credit limits, and maximising, I guess, for your situation. The whole notion, especially from a US perspective, is having more credit because it builds up a credit file, doesn't quite stand true in Australia. It's more about having what we call positive credit reporting. So even if you don't have any credit as such, you may have a phone bill, which obviously is inbuilt into that credit reporting system. So the whole idea, especially when I speak to some of our resident medical officers and some of our GPs, the idea of perhaps having a credit card before they go and apply for a home loan, is the whole notion that I get presented with, but it's actually going to be potentially to your detriment, because a credit card, for example, every 10,000 credit limit, irrespective of whether you use the limit or not, tends to reduce the average borrowing capacity by around 30 to 50,000 for a home loan. So it can actually work against you in that instance. So it's just understanding what credit limits actually mean, and does that actually help achieve the goal that you're seeking to work towards. So keep that in mind as well. The third point is not managing debt with savings. So that's obviously making sure that you write things down and just not bottling things up, because especially if you've got a lot of commitments and a lot of things that are going up, keeping things in your mind can obviously manifest and just fester. So it's important that you kind of debrief it, put it in some form of spreadsheet, get a better sense so you're not having to remember all these things. You've got a lot of important tasks that you're focusing on each day, and I think it's really important that you kind of rid yourself of having those extra kind of finance matters in your mind as well. So that leads me to my next point around storing it in your head. Something that we should really be focusing on removing that, so that you can focus more on the more important things in your day-to-day life as well. And then finally, we've touched on the impulse buys as well. Again, it's very difficult in this day and age where we're kind of continually being exposed to all these impromptu and impulsive items, but it's a case of maybe splurging every so often and rewarding yourself, but not becoming unstuck, especially if you're in an environment that cultivates a lot of those sorts of behaviors that manifest in spending a lot more. So just keeping a very even mind around what things are important to you, and just working backwards and thinking, will this help support my longer term decision? If not, maybe let's revise it and look at an alternative. Okay, so this slide talks about the different kinds of debt. So we've got credit cards, car loans, home loans, and HECS. And it also looks at factors of a loan to consider whenever you're looking at these types of items. Again, really comes down to that life stage as well, and what's important to you, because if you're perhaps not at the stage of acquiring a house, it might be buying your first car, or perhaps having a credit card just to manage your spending. So you obviously may go down that path of engaging and pursuing those items. But again, it's a case of just finding out which I guess product or which item is going to be the most suitable based on that future benefit component and essential or non-essential purpose. So if we look at, for example, the home loan, of course, as the name suggests, it speaks to acquiring both an owner-occupied property to live in, or it could also mean seeking out a loan for an investment loan as well to buy a property that's going to be deriving income for you longer term. It may be for capital gains purposes or capital growth, I should say. So it's about working out what's going to be most important for you as well. We've touched on HECS already, being a repayment that automatically comes out based on the income that is described, or your adjusted income, as Julie's mentioned. If you choose, you can obviously apply extra towards that. A conversation with your accountant would be sensible as to how that impacts your longer term goals. How does that impact your borrowing capacity as well? It does take into account, especially for a home loan, it does take a bit of a swipe off that. But again, every situation is different. Car loans, once more, whether we go down the different finance options, there's a myriad of things to be mindful of there, and credit cards as well. There are a few benefits, notwithstanding that it impacts your ability to borrow for a home loan, but they do have a few perks. And if you can manage your spending well, you can accrue points. It's a good budgeting tool in some instances as well. So just be mindful of those things. And interest rates are obviously impacted as well, depending on which product we go down the path of. And obviously, as Premier Bankers, we're quite fluent and in each of those sorts of areas, so we can obviously have those conversations at length. So we'll move now to the two popular strategies to reduce debt. And one of which is known as the avalanche strategy. As the name suggests, it basically means applying any surplus funds towards the debt which has the highest interest rate. And there's a bit of a trade-off there, of course, the trade-off being initially you'll pay less interest over the duration of the term, and you can obviously should get one down quicker, but obviously it can be a bit slower if it's just the highest interest rate. It could be the higher debt that might take a little bit longer to achieve. So that's the avalanche strategy. If we look at the snowball strategy, again, it's more about focusing on that smaller balance first, because it does cultivate a more of a money mindset, because you're knocking down one of those dominoes, so that it can obviously just put you in a better mindset. So as the notion says here, you can be disciplined and motivated as you can progress sooner. The converse is that you may be paying off a debt that perhaps doesn't have a higher interest rate, and it may be sensible in your situation to pay the one with the highest interest rate. Depends as well, and that's where, from an accounting perspective, deductibility as well for interest, and obviously I won't delve into that into too much detail, but that can also be something to be mindful of too. And finally, when we do speak about managing your finances and obviously your credit history and credit score, you might need this information if you're applying for loans. If you're both, of course, wanting to make sure jointly, as if with a spouse or a friend or whoever, just being mindful of your credit rating as well. There are different options. For example, with Commonwealth, you can check within the Commonwealth app as well as NetBank, just to get a sense of if there is anything untoward on your credit record that you may or may not be aware of. So that's a good strategy, just to ensure that you can get a sense of where you stand prior to engaging with a banker, or even we can help direct you in the right place. And finally, whenever it does come to managing and making sure that you're on the right path with managing your finances and your financial essentials, first point of reference, obviously come speak to us as your Premier Bankers, because we can provide a holistic service and point you in the right direction in the bank. If it's something that we don't have direct oversight over, we have a dedicated financial support line on 13 30 95. There's also external providers like your national debt line as well that can also support. But as I mentioned earlier, your team of professionals, including your accountant, your financial planner, your banker, we're all here to collaborate together to ensure that we're giving you the most, managing your finances in a very sensible manner, to ensure that you're achieving the goals that you're seeking to achieve. So in summary and to recap, achieving financial well-being we've got the everyday side of things, so understanding, and it touches on what Binny's mentioned this evening around where your money flows are being directed. So setting up those direct debits are really important because it gives you a better sense of structure and I think routine, so that you know where your funds are going, and whether that's setting up those bucket or silos for yourself could be a useful tactic. So it helps to navigate where those funds are being directed to, and obviously putting money aside for that everyday or emergency fund, just in the event of that rainy day occurring, which can potentially happen to all of us. Rainy day once more, so having that 3 months, or ideally if we can buffer that up, again depending on everyone's scenario, just to weather any storm that may come about, and obviously having the insurances in place, so that you can afford if your savings may be depleted, and that's perhaps going down the more financial planning route. But again, we can be a segue into supporting with that and getting in front of the right person around the life insurances, income protections, and so forth. And then finally, where we spoke about those one day or achieving those goals, and whether that's a first home, whether that's an investment property, whether it's buying a vehicle, whether it's buying into a practice as well, making sure that we prioritize those goals and put in place those roadmaps or steps to ensure that we can get there in the most sensible and succinct way to ensure that you can work towards that retirement that you've been looking forward to. So that concludes the formal component of the webinar. Just want to thank you for your time this evening, and we're open to any questions or any queries that may have arisen during our discussion. Thank you.
Thanks so much, Anthony, Julie, and Binny. We really appreciate you giving up your time to provide some information to our registrars and new fellows. We did have a couple of questions that came in before the session, so I'll ask those now. As some of them will probably have already been addressed, but it doesn't hurt to just refresh ourselves on them. So one related to Julie, who was talking about travel and recording for taxation purposes. What's the best way to record information for your travels? You know, is there like a template you should be using, and so on?
Yeah, fantastic. So if we're talking about motor vehicle travel, particularly, and that logbook that we're talking about, there are certain criteria that you do need to make sure that you're keeping: opening odometer, closing odometer, purpose of trip, where you've been, how many kilometers, etc. So there are a number of items that you do need to actually keep record of. You can head to the William Buck website, you can head to the ATO website to list out those sort of things, or you can reach out directly to me. In terms of other types of travel, so I did mention if we're traveling for 6 or more consecutive nights, traveling away for work for 6 or more consecutive nights, we do need to keep a travel diary for that period of time. That travel diary can simply be a note in your calendar, in your phone. It can be a note that you've made. It can be an email to your accountant. It's just making sure that we jot those things down and that we've got a record of that. In terms of traveling in the car for cents per kilometre method, it is important to make sure that we're able to substantiate how many kilometres we've travelled, where we've travelled. So again, a diary note or an Excel spreadsheet or some sort of record is quite important.
No, thank you for that. One of the other questions that came through is, with the increase in remote video consultations in response to COVID and just in general practice now, is there any additional work that needs to be done from a taxation perspective to note days where you work from home and do consultations off-site from clinics?
Yeah, so it is important to note down your hours that you are working from home. So there are some changes coming in relation to claiming your work from home hours, but it really is important to make sure that you are making sure that we keep a record of how many hours you've logged on, how many hours you've completed work after that time, making sure we really are keeping a record of that. I have heard of, Big Brother is watching and seeing where we are and whether we're at work or whether we're logged on remotely and those sort of things. So again, it comes down to that record keeping and making sure that we have appropriate documentation and notes in relation to that. So again, in your phone, in your notes, in an Excel spreadsheet, just make sure we're keeping track of that somewhere to be able to substantiate that claim on our tax returns.
Oh, brilliant, thank you.
Of course.
So in terms of saving up for a house, we've got a question here about whether or not it's better to save up for a 20% deposit before you apply for a home loan, or whether it's better to start the process earlier before you've hit those saving goals.
I can, do you want to take that, or I can have a quick look into it, Vinny, and then we can feed off each other, I guess.
Yeah, you can go ahead.
Wonderful. So, great question. I guess it depends again on what the intention is, because as medical clinicians as well, the traditional 20% deposit isn't quite the only option. We can go down the path of what we call under a Medico Plus. So with as little as a 5% deposit plus the cost of stamp duty, we can still lend without that lender's mortgage insurance. So it's not something that's actively advertised because it's not open to the general kind of population as such, but as medical professionals for owner occupied and for investment, we can go up to those parameters so that you may be able to put those savings towards other options if you're studying at the minute, but also if you've got other commitments as well. So it's not necessarily that 20%. We can go up to basically 95% plus the cost of the stamp duty as well. And that's contingent on every state and territory, because unfortunately stamp duty varies. So the higher the price, generally speaking, the higher the stamp duty that is applicable. There are some kind of concessions based on each state for first home buyers, for example, but depending again on those price points, that will obviously dictate whether you get any concessions for stamp duty and so forth. Did you want to add anything there, Binny?
There's one thing I just wanted to add is it's never a good time to purchasing a property. Always right now is the best time if you've got all the affordability as well. Like it depends, everyone's situation is different. However, if you do have the capacity to enter property market early, then you also need to factor in other costs associated with that as well. I'm not saying that it's not good to save for the 20% deposit. However, there's sometimes if it takes you 3 years to save up for your 20% deposit, by the time 3 years after, the property price will not be the same as where we are right now. So again, it's very important to seek some professional advice on this as well. So have a chat with the banker, find out about your borrowing capacity. Everyone's situation is different, but it's good to have a plan and then work towards that goal.
Brilliant, thank you both. And I think this is a really good reminder for everyone that we do have 2 more webinars in the series, with the next one being Pathway to Property, where saving up for a home loan, establishing a home loan, all of that information will be covered much more. And that will be 1 week from today with our same wonderful panelists as well. We look like we haven't had too many questions come through, and most of them have already been answered within the session itself. So I think we'll call it there. Thank you all so much for coming along today and joining us for this session. And a huge thank you to Anthony, Binny, and Julie for being our panelists. And then also a big thank you to Kim for being our backup in case we weren't sure how to answer a question. He hasn't said too much, but he's been there keeping an eye on everything for us. So we really appreciate having you all here. And we're looking forward to seeing you all next week. So with that, we'll say goodbye, and this recording will be available within a day or 2. Thank you very much.
Thanks, Ari. Appreciate it.
Bye.